Hey everybody, Chris here to answer the question, will the Fed's rate resolve lead to a recession? So after a barely positive May, June saw the bear market return. We ended up with the worst first half performance since 1970. A mid-month 75 basis point rate increase followed by Fed Chairman Powell testimony to Congress convinced markets that inflation is the priority for the Fed. Chairman Powell indicated that the current level of inflation, 8.6%, will require a short-term rate of at least 3% to get to a neutral level. With the Fed's fund rate currently at about 1.5%, that means several more rate increases this year. Now, are we headed for a recession? Are we already there? Or is the Fed's plan to slow the economy to bring the labor markets into balance beginning to work? So let's take a look at some numbers. The Atlanta Fed has created a model of GDP that attempts to forecast this key in an economic indicator. The GDP Now model estimate for real GDP growth in the second quarter of 2022 is a negative 2.1%. The official GDP number for the first quarter was a decline of 1.6%. Now, if the GDP Now forecast proved accurate for the second quarter, that would fit the technical definition of a recession, and that's 2 quarters of economic contraction. The June Manufacturer Purchasing Managers Index, or PMI, registered 53%. That's down 3.1% from May, but this figure still indicates expansion in the overall economy for the 25th month in a row. However, this is the lowest manufacturing PMI read since June 2020. Now, the U.S. Bureau of Economic Analysis, BEA, released a consumer spending estimate on June 30th. Personal consumption expenditures increased, but inflation-adjusted spending dropped 0.4%. Now, the Department of Labor reported that in the week ending June 25th, that seasonally adjusted initial unemployment claims was 231,000, a decrease of 2,000. It's lots of numbers. What does it all add up to, right? So the official GDP number doesn't come out until July 28th, and a lot can happen in a month. Upcoming data releases on labor markets and inflation will guide what the Fed does at the July meeting, and more data will hopefully remove some of the uncertainty, particularly if inflation trends back down even a little bit. Chairman Powell has been clear, though, in stating that we are committed to and will succeed in getting inflation down to 2%. The process is highly likely to involve some pain, but the worst pain would be from failing to address this high inflation and allowing it to become persistent. Now, the pain Powell is talking about isn't some stock market pain. Labor markets will contract, which means wage gains may not persist and unemployment will increase. So for the equity markets, the S&P's year-to-date down 20.6%. That's the worst first half since 1970. The Dow Jones dropped 15.3% year-to-date, worst first half since 62. NASDAQ down 29.5%, the worst first half on record. Now, when we're talking about the bond markets, the 10-year U.S. Treasury ended the month at 2.98%. 3-month U.S. Treasury ended at 1.77%. So what does that mean the smart investor should do? So there isn't enough data to know if the Fed will be successful in engineering a soft landing, or if we do enter a recession, how long it will last. Controlling the things that you can is important. Reviewing spending, considering putting off big expenses, top up those emergency funds, shift from spending to saving, and we still have 6 months left in the year, so don't neglect those 401k savings or educational accounts. Stock prices have fallen, so it may be time to take advantage of tax-saving strategies. Tax loss harvesting can offset gains elsewhere, and if you've been considering Roth conversions, now may be an ideal time. Lower stock values mean lower taxes, and any growth on those assets in the Roth remain tax-free. Keep your long-term plan in mind. Manage those emotions, keeping a balance and taking a realistic view, but keeping your goals in front of you. Don't make impetuous moves and focus on the things that you can control. This is Christopher Klepp, and this has been your Bridge Towards Wealth.